Howdy. Welcome back to Dion Talk. In today's video, I'm going to talk about the cash flow from one of my deals. I'm going to break down how I found the property and how I ran the numbers to decide if I wanted to make an offer or not. Running the numbers is just the first step. After I find out if the math works or not, I've got a bunch of other criteria that I use to make sure that I have very little tenant turnover and a large pool of tenants, just in case I need to if I have a tenant turnover. When a lot of us are starting out and we're first starting to figure out how real estate investing works, we hear over and over and over again how you need to run the numbers. Look at a lot of deals. The more deals you look at, the better you'll get at doing it. But what numbers are they talking about? There's a lot of different ways of looking at properties. There's the 1% rule, the cash-on-cash return rule, the profit per door rule. None of these are really rules, they're all guidelines, but which one are you going to choose? Depending on the market that you are in and the level of your experience, each one of these rules can work, or they can get you into trouble. Let's take them each one at a time. The 1% rule is the idea that the rent coming in every month is worth 1% of the total value of the property. Simple numbers, if there was a property worth $100,000, the rent coming in every month would be $1,000. If you're in an area with a lot of inventory, a quick way to narrow down the number of properties that you look at is to take the 1% rule. But there's a couple of issues with it. And first off, not one of my properties has ever come close to meeting the 1% rule. If you're in a state where the property taxes for your property are $1,000 a year, or another state where the property taxes for a property are $16,000 a year, that really changes how much you're going to be spending every month to have that property. What if you're looking at a property that doesn't have an HOA, or a property that has an HOA that's $500 a month? What if you're looking at a property that was built 2 years ago, or a property that was built 102 years ago? The costs for each property are very different every month. So for me, the 1% rule hasn't worked. So let's look at this other way that people run the numbers. And I hear this way brought up a lot in the BiggerPockets forums, in the official BiggerPockets Facebook group, in the Real Estate Rookie group. A lot of people talk about the cash per door. Do you make $100 per door, $200 per door, $500, $1,000? And for me, this almost doesn't matter. Let's say your goal was to make $200 per door. If you spent $1 to get the property, that's a pretty good return. If you spent $1 million to get that property, that's not that good of a return. I think the cash per door method works best when you're talking about the BRRRR strategy, when you buy, rehab, rent out, refinance, repeat a property, where you can pretty much pull all of your money back out to where it didn't cost you any money to get that property. $100 or $200 a door is pretty good when there was no out-of-pocket cost. But since I don't use the BRRRR method, and I think that the 1% rule is slightly flawed, what's worked best for me is the cash-on-cash return method. An accountant would call this the yield. How much money do you make every year divided by the cost to acquire the asset? In real estate, this is your down payment, your closing costs, and your immediate repairs. That is your cost to acquire. What you need to do is take the amount of profit you have every year, how much money you made, and divide that by your cost to acquire. Figuring out how much money you made every year isn't that difficult, but there's a simple mistake that a lot of people make. When figuring out how much money you made every year, most people will take their income minus their expenses. If you paid all cash, you're just going to have insurance and taxes. If you have a mortgage, you're going to have principal, interest, taxes, and insurance. But don't forget, we have to set aside money for CapEx, vacancy, repairs. There are going to be costs that come up in the future that property needs to be paying for the whole time you have it. And when running the numbers to see if I want to buy a property or not, even though I've never had a vacancy, I still set aside 5% for vacancy. And even though I've never come close to spending this much in a year, even those years that I replaced a roof, I set aside 10% of gross rents for CapEx and maintenance. It may be different in your area. If your properties are older, you may need more. If they're newer, you may need less. You can check your vacancy rate, and if it's higher, set aside more. If it's lower, I would still set aside 5%. An area's vacancy rate is a statistic, and remember, statistics mean nothing when an event happens to you. So hopefully you're understanding now that the metric that I use to determine if I want to buy a property or not is cash-on-cash return on investment. And what I'm going to do now is I'm going to break down the actual numbers that I looked at when I purchased a property. I'm going to break down the third property that I purchased. I had a single family house, I was house hacking a duplex, and this was my first investment property duplex that I was purchasing. So far, all of my properties I found on the MLS. I have 3 real estate agents with auto searches set up, and this was just one of the properties that came in on an auto search. It was listed at the price that you see on the picture of $298,000. I made an asking price offer of $298,000 with $10,000 in earnest money. And this was a few years ago before the housing market got all crazy, and an asking price offer now probably wouldn't work. Most properties, when they hit the MLS, within an hour or two have multiple over asking price offers. Some of them are all cash, some waive contingencies. And so what I've had to do more recently to catch a seller's attention is to make a bigger earnest amount. On my last purchase, I put $50,000 in earnest money. That's actually not that risky because I still had an inspection clause and an appraisal clause, so I could get out of the deal if I wanted to without losing my money. And my asking price offer with $10,000 in earnest money was actually rejected. They took someone else's offer at $300,000, so I made sure to let the listing agent know that I would like my offer to be in a second position. In case their deal didn't go through, then my offer was still a good offer. The first deal fell through. They reached out to me and said, would you like to get this for the $300,000 that we accepted from the other person? And I said, no, $298,000 was my offer. So I almost lost a deal over $2,000 stretched out over 30 years. Not something I would do today. The listing agent came back and said, okay, we accept your $298,000. So the house was under contract. So how did I know that $298,000 worked for me? First thing I had to do was figure out how much the mortgage was going to be. Now, BiggerPockets has some really good calculators. If you have access to them, they are the best way to get a really good looking sheet, especially if you need to convince a partner or a significant other that this is a purchase you want to do. For me, since I don't have to convince somebody else, I use the CDS rental calculator app, which you can get in the App Store for free. And it's not as pretty looking, but it just runs the numbers, tells you the math. The CDS rental calculator app was actually made by a YouTuber named Chandler David Smith. Great content. I've learned a lot from him. The mortgage also includes taxes and insurance, which most times are listed in the MLS listing of the property. To find out what the insurance is going to cost, you might have an insurance broker you can call. I like to call around and get quotes from different people to always make sure I'm getting a good competitive rate. So when figuring out what the mortgage is going to be, you need to know what the taxes are, insurance is going to cost, the price of the property minus however much you put down. If you're using an owner-occupied FHA loan and you go all the way down to 3.5%, I've heard that it can even be 3%, or a conventional loan. I've heard of 5, 10, 15, 20%. It changes every year based on lender fears. Or you can use the VA loan and do 0 down. I have a VA loan. I haven't used it yet, and I probably will someday, but not today. I like to keep my VA loan in my back pocket just in case someday the perfect property pops up. It's the best deal ever, and I don't have the down payment saved up, then I have the VA loan as an option. But for this property, the price was $298,000. I was putting down 25% since it was an investment property. That was $72,250 as a down payment. Now here's something to think about. If you're using an FHA loan where you're putting down less than $10,000, or using your VA loan where you're putting down $0, or you find a conventional lender for less than 25% down, even on an investment property, I would still run the numbers like you did 25% down. That's how I decide if this is a good property or not. Because if you put $0 down and you make $1 a year, that's a good return. Except you have to manage a property and take care of a tenant. I want to make sure that my return is big enough to justify the time it takes for me to manage a property and a tenant. Plus closing costs of about 3% of the purchase price, which in this instance was $8,940. And when you're looking at purchasing a property, don't forget that you have the cost to make it rent ready, or those immediate repairs. And if you've seen any of my other content, you know that I am super lazy. So my goal is to buy already occupied or rent ready properties that need very little work. This property needed less than $1,000. Tiny little cosmetic things to just make it look better. Everything worked. So my out-of-pocket cost to acquire this asset was $82,290. And really quick math, my goal is to get at least a 10% or better cash-on-cash return. So if my out-of-pocket expenses were about $82,000, as long as I make $8,200 a year, I'm going to meet or beat my 10% desired return. So with the interest rate that I got on the loan and finding out the taxes and the insurance, I knew that my mortgage every month with this down payment, the amount that was left that I had to finance, my monthly expense was going to be $1,300 a month. It's a little less than that, but I average up to $1,300. And now that I knew what the expense was going to be, I had to figure out what the income was going to be. To get the average rents for an area, I do 3 things. I don't usually rely on what the listing agent says or what's in the current leases. I check Craigslist for an area average. I use Rentometer. I actually have an account, and if you wait until Cyber Monday every year, it usually drops down to about $40 for an entire year. And I call the housing authority. Section 8 is usually spot on for area averages, and they're transparent about what they'll pay per bedroom. This duplex has 3 bedrooms and 1.25 bathrooms on each side. I didn't know what 0.25 bathrooms was until I walked through this place, but apparently there is a sink in the master bedroom, which counts as 0.25 of a bathroom. And the area average rents for a 3-bedroom off of Rentometer that you see right here, the average is $16.91 a month. But whenever I'm factoring rents, I always factor at 10% below that. If I had to rent 10% below what the area average is, I would have a better chance at having more tenants in line waiting for a place to open. You don't have to rent 10% below the area average, but when I'm running the numbers, I like to be very conservative to make sure that I don't shoot myself in the foot. The tenants that were living in this property have been there a long time, and their rents were really low. Both sides were renting it as though it were less than a 3-bedroom place. One side was using 2 bedrooms, and then 1 bedroom was a playroom. The other side, one of the bedrooms was being used as an art room. So for some reason, the previous owner didn't rent it out as though it was a 3-bedroom, and each side was paying $1,200 a month. So not counting on being able to increase the rents and not counting on being able to kick the tenants out and put in new tenants at a better rate, let's look at the numbers the way they were when I purchased it. If we have $1,200 a month coming in from each tenant, that's $2,400. Minus a $1,300 mortgage, taking away $240 for repairs and capex, and taking away $120 for vacancy, that leaves me with $740 a month in pure cash flow. Actual profit after all of these expenses. $740 a month times 12 months means that my annual profit is $8,880. If we divide $8,880 by my cost to acquire, that was $82,290. My yield, my cash-on-cash return, is 10.07% return. So quick math, I was getting better than a 10% return on the current rents, and the area average that I was able to find the way that I have used with those 3 ways that I check was over $1,600 a month. And if I average it down like I like to $1,500 a month, when I rented out both sides at $1,500 a month, my return on my cost to acquire would be over 18%. That's why this was a good deal. And I was able to figure all of this out before I left my office. I checked online, I called the housing authority, I went to Rentometer. I was able to calculate this using the CDS rental calculator app and make the offer before I've ever seen the property or taken a tour or gone for an inspection. That is all stuff that you can do after you have a property under contract. And keep in mind that math is just the first step. Yes, this made sense by the numbers. I knew I was going to make the profit that I wanted to. But then I have other criteria that I like to do that helps me limit tenant turnover and make sure that it's going to be a place that I don't have sitting vacant for a long time. Those are really simple. It's side-by-side unit, so I don't have noise complaints from tenants living above or below another. It is a place that is at least 2 bedrooms or more with a garage, because more space equals more stuff, which means less likely to move. And I like washer-dryer hookups inside each unit because tenants don't like to use shared laundry or a laundromat. With those criteria, which this met all of them, I knew that this was an offer worth making. I really hope I made it worth your time clicking on this video today. If you liked it, if you thought you got anything out of it, please hit like, hit subscribe, share this with a friend. Hopefully it can help them figure out how to calculate the way that they're going to look at buying properties. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.